Okay, it's a pleasure to finally get a chance to address the students here in a lecture.
They the last 15 minutes?
Yes.
You said that lots.
Okay, the title of this lecture is called Skyscrapers and the Housing Crisis. I also have a lecture on Saturday called Prediction and Business Cycles. In this lecture, I'm going to show you how you can predict, and on the Saturday lecture, I'm going to tell you that you cannot predict. Okay, so subtle distinctions here. The focus of this lecture is a paper I published in the spring of 2005 called Skyscrapers and Business Cycles. And in that paper, basically what I showed was that there is a eerie correlation between the building of a record-setting tall skyscraper and the onset of a world economic crisis. The correlation begins historically. I'm not sure if we're going to be able to see this all that well. But it's a century-long or longer correlation. The Panic of 1907 was the crisis that actually helped bring about the establishment of the Federal Reserve. Things were so bad that they said we needed a central bank to stabilize things. Prior to the Panic of 1907, construction on the Singer Building in New York City and the Metropolitan Life Building in New York City was undertaken. The Panic of 1907 occurred, and these record-setting skyscrapers were completed in the aftermath of that in 1908 and 1909. The next record was the Woolworth Building, which was completed in 1913. Then, prior to the Great Depression, construction on the Chrysler Building, 40 Wall Street, and the Empire State Building was begun. Of course, the stock market crashed in 1929, and in the aftermath of that crash, the Chrysler Building, the Empire State Building, and 40 Wall Street, which is now a Trump property, were opened in really the aftermath of the stock market crash. And then prior to the onset of the stagflation of the 1970s, World Trade Tower 1 and 2 and the Sears Building was begun. Of course, beginning in 1970, there was a recession. Things were so bad that Nixon put us on wage and price controls all across the economy. He took us off the gold standard. And in the aftermath of this, the World Trade Towers were opened and the Sears Tower opened. And what we saw after that was the stagflation of the 1970s and the mini depression of the early 1980s in the United States. Prior to the Asian contagion, as it was called, the crisis, currency crisis and economic crisis in the Asian Tigers, which was their nickname prior to this crisis, Hong Kong, Taiwan, the Philippines, Malaysia, Indonesia, their economies were growing great guns. Construction on the Petronas Towers was begun in the mid-1990s, and it opened very near the onset of this Asian contagion crisis. And then finally, and more recently, the Burj Dubai Tower opened in January of this year, setting a new record, mammothly tall building, 200 stories. It was begun many years ago. And it too set a record, and it too is associated with the current economic crisis. And what I did in that paper was basically show why Austrians would expect that correlation to happen, providing a theoretical connection between building the record-setting skyscraper and an economic crisis. And that's basically what we're going to go through taking a look at here today. Now, of course, the housing crisis began a long time ago. One of the seeds of the housing crisis was a tax break for houses that was passed in 1997. And so we saw housing start to take off in 1997, but that's really not a business cycle phenomenon, but a tax phenomenon whereby we would expect everybody to own more housing. The bubble in housing really begins in 2001 and 2002. Basically what the bubble is too many houses being built, houses that are bigger and better, and so forth. And of course what we saw is millions of extra homes being built in the United States and around the world, really. Many other countries around the world are also have experienced the housing bubble and the housing bust. The onset of the crisis occurred in the fall of 2007, so it's been with us for quite a while. The crisis really emerged in 2008, and of course the government response to that with bailouts and stimulus packages and so forth began in 2008 and 2009. And of course, just this week we were told that the economy is recovering from Chairman Bernanke, the White House. Of course, they've been basically saying the same thing for about a year and a half now, so I'm not sure exactly how seriously we should take them. Okay. Basically going to take a look at what myself and other Austrians were doing during this period of time. You notice that this article, which was published in LewRockwell.com, occurred in February 9th, 2004. Okay, Austrians had already been writing about the housing bubble is late 2003, and then I was started to write about it in 2004. This is at the height, or near the height of the bubble. Everybody else was saying that you can't lose money in real estate, housing prices never go down, things of that nature. In June, I published a big article on Mises.org on the daily articles, and also in the free market. In this article, I sort of laid out using Austrian analysis to look at the housing situation in the United States, look at some of the statistics that were indicative of a housing bubble. Again, on LewRockwell.com, this article appeared on LewRockwell.com August 8th, 2005. And the title is the housing bubble popping?, where I speculated using some technical analysis that this would be the top in the housing stocks. The index of housing stocks, the companies that make houses, had increased by over 200% since the year 2000 at this point. The index was at a level of about 600. Again, this was a time when everybody was painting a rosy picture of the U.S. economy, of housing in particular. And the all-time high in the stock market occurred on July 28th. The all-time high in the housing stock index occurred on July 28th. So this speculation that I made on LewRockwell.com on August 8th turned out to be a correct prediction of the top in the housing stocks. In 2006, I published this working paper, The Economics of a Housing Bubble, first week of June 2006. I presented it over at the College of Business shortly thereafter. Nobody believed me. Everybody ridiculed me. They wanted me to repeat my answers about did I think there would be a bust, did I think there would be a recession, so on and so forth. And I would say yes, yes. And they all disagreed, basically. They couldn't believe that there could ever be any trouble in housing. And then finally, well, I've got a couple more here, but August 7th, 2007, I made this blog post on Mises.org. The Burj Dubai Tower had set a record over in the UAE. It wasn't completed, but it had set the record for the highest constructed building in the world. And so I made this blog post saying, well, according to the skyscraper index or model, this is an indication or crisis signal that things are going to go bad. Again, nobody really paid any attention to it. Nobody believed me. Even on Mises.org, there was only like 5 comments on this post, and one of which was my own. So there's really only 4. And, in publishing the article in the spring of 2005, it's kind of a little scary, actually, because here you are, you're saying, here's my model, here's my theory, and yet after that, you don't have no control over what actually happens. Well, it did happen. The crisis signal was sent at about the same time that the stock market was at its all-time high in the fall of 2007. Nothing had been revealed as far as trouble in the housing market in the U.S. The unemployment rate was very low. The economy was moving ahead, moving forward at bubble speed. And here I am predicting an economic depression. But it actually came to pass, and nobody really paid much attention to it again until the Dubai Tower was actually finished and it was opening up, and they were declaring bankruptcy and in need of a $50 billion bailout from their brothers over in Abu Dhabi. Thank you very much. So basically the idea here is that the skyscraper model is a very helpful indicator of what's going on in the overall economy. And it actually even applies to smaller scale projects. For example, I looked at the construction of the tallest building in the state of Alabama over time, when they occurred, and what was happening in the economy. And some of those records were set during periods of bubble and bust in the overall economy, and some of them were related to more local conditions or local industries and booms and busts in those industries. Another fellow has looked at the same thing with respect to the tallest buildings in Michigan and the state of Arkansas, and has found a similar correlation between the building of record-setting buildings in those states and economic crises. Okay. So, skyscrapers. How in the world can we relate skyscrapers to the business cycle? And in particular, severe economic crises? Well, in a lot of ways. Start with the most basic thing is that skyscrapers are just another form of real estate. Houses are real estate, buildings are real estate, schools, warehouses, it's all real estate of one form or another. Residential, commercial. Skyscrapers just happen to be a particular form of real estate. And actually, it's a form of real estate which is indicative of the modern capitalist economy. I was just talking beforehand, before the lecture, that if you go back into the 18th and 19th century, the indicative factor in the economy was, for example, like the railroads. The railroads came in the 19th century. They were the biggest type of firm in existence. They represented the biggest form of capital investment, and they also, of course, were an important new technology. And we always look for new technology when we look at business cycles, because technology is very much related to the real changes that occur in an economy, whether it's through natural influences and factors or whether it's artificial factors that have been brought about by the central bank. So it's real estate. Second, it's a very long-term project. Okay, skyscrapers take years to produce. They very often take years just to design. And so it's not uncommon for people to design very, very tall buildings or very, very large buildings well in advance before they're financed or anything like that. So again, the Austrian theory of the business cycle says that when the central bank injects new money and new credit and lowers the interest rate, one of the things that happens is that entrepreneurs tend to look for more roundabout and longer term projects. And of course, once a skyscraper has been built, it stays in existence for a very long time. All of those records that I referred to earlier, all those buildings are still standing except for the trade towers. And those were brought down, obviously, in an artificial sense. They would still be in business today if they hadn't been bombed. So when you build a record-setting skyscraper, it's going to be there a very long time. So it's sort of the basic aspects of the Austrian theory of the business cycle very much look like skyscrapers would be part of that story. But the way in which I connected skyscrapers with the Austrian theory of the business cycle is by looking at Cantillon effects. Cantillon, Cantillon. Named after the first economic theorist. His name is Richard Cantillon, an Irishman, banker, an investor in the Mississippi Company and the Mississippi Bubble. He was not only one of the richest private individuals in the world circa the 1720s, but he actually wrote the first book in economic theory. And one of the things he does in that book is show the impact of money. Remember, the economist of the day, the mercantilists, which was mentioned by Guido Hülsmann, they viewed wealth as money. The more money you had, the wealthier you are. That was the mercantilist thing, which is okay if you think it or if I think it. But if the king thinks of it or the prime minister thinks of it in those ways, it can lead to very bad public policy. Because then if wealth is what you're going after and money is wealth, then you are going to be searching to build up more and more money, which of course, as Austrians, we know that more money is just inflation. It doesn't really help the overall economy. It's production and consumption that are the main concern of wealth. And so Cantillon showed basically how money affects the economy. And in his day, he looked at a variety of different ways in which new money entering the economy could actually have a real impact on the economy. In today's terms, or for the last 100 years, all the new money in the economy basically enters as a result of the policies of the Federal Reserve. Okay, so in every case now, increases in the money supply are the result of the actions of the central banks and the banking system. But in Cantillon's day, it could be for a variety of different reasons. Now, the Cantillon effects are as follows. First, money enters the economy. This changes relative prices in the economy, depending upon where the new money enters the economy. The change in relative prices changes the structure of production. Imagine, for example, if somebody started sending $1,000 every day to every 16-year-old boy in the United States, what would the economy look like? Yeah, everything would be video games. You know, the grocery stores would have to convert to video game stores or whatever. All production would start to be going in the direction of video games. And the relative prices of everything else would begin to fall as the money poured into the video game industry, as if not enough is pouring in already. But obviously, that would have, as you see the money flowing into the economy, it affects prices, then it affects the structure of production. And if all of a sudden those $1,000 checks stopped, showing up in the mailboxes of all these 16-year-old boys, then that structure of production that had grown up on that money would then experience a crisis. So he explored a variety of different relative effects by injecting the money at different points in the economy. He said, for example, if the money comes into the hands of producers, at the first round effect, the money ends up in the hands of producers or savers. What would happen is there would be, you'd see the interest rate fall under that condition because there'd be more money available. The supply of loanable funds would increase. However, if the same amount of money entered into the hands of consumers rather than producers and savers, the exact opposite would happen. Because as consumers took their new money and they went out and started spending it, then producers would have to ramp up production. And so what they would do is to borrow more money to produce more factories, more raw materials, and so forth. So as a result, the interest rate would rise. And I think this is an important perspective because, again, the Austrian theory of the business cycle is geared around the notion that the central bank creates all the new money. It injects all the new money. But in reality, that effect of new money can be to reduce interest rates, or it can also be to increase interest rates. Now, there are three Cantillon effects that are relevant for skyscrapers. The first, in terms of looking at an environment where the central bank does have a policy and does increase or control the supply of money, the first Cantillon effect is an increase in the price of land. If a central bank reduces the interest rate and increases the supply of money, what it will do is increase the demand for land. If the interest rates are lower, the opportunity cost of owning land declines. There's an increased demand for land, and so there's an increase in the price of land. This effect is particularly important or relevant to high-priced land, the best land. With real estate, there's three factors in the price of real estate: location, location, and location. And the best locations have a premium price. And when the Federal Reserve lowers the interest rate, it's going to have a particularly pronounced effect on the price of premium land. This higher price induces developers to build taller buildings. Everybody in the construction and development business understands this, that if you increase the price of land, that creates an incentive to build buildings taller. Okay, the most expensive land in Auburn is basically in downtown Auburn, and that's where you find the tallest buildings. It's not a random sort of thing. It's not like they're sort of drawn to one another by some sort of magnetic force. But this is also true in all cities. All cities, the closer you get to the most important piece of land, the taller the buildings go. Manhattan is a good example in New York City. That's where all the tall buildings go because that's where the price of land is the highest. Imagine if you had to pay $1 million for a piece of land. And it would cost you, say, $1 million to build the first floor. Well, then the first floor cost you $2 million. and the land cost was $1 million. So the land cost of that one floor is very high. But if you built a 5-story building on that same lot, you'd have the $1 million for the land and $4 million for the building, so that the per floor cost was not $2 million per floor, but $1.25 million per floor. And if you built 100 stories, obviously the impact of the land cost would get lower and lower and lower. What offsets that is, of course, the higher you build, the more expensive the construction cost on each level goes up. It's more and more expensive. So the first Cantillon effect is on the price of land, and that impact on the price of land induces people to build taller. The second Cantillon effect is on the size of the firm, the size of the company itself. When the Fed creates lower interest rates and easy credit conditions in the economy, it provides an incentive to create larger firms. Firms want to become more capital intensive, and they want to do so in order to exploit economies of scale. I'm going to give you an example of what's called a more roundabout means of production. This is something you've probably seen in your readings. It's probably something you've obviously heard of in some of the lectures, that there's this idea that begins with von Bavarick that interest rates and more roundabout means of production are linked. Now, typically, of course, more roundabout means of production, that doesn't seem like what a business person would do. They would want to have a direct means of production to get it done as quickly and as directly as possible. So the only time we typically would resort to more roundabout means of production is if they're much more productive than the direct means of production. Okay, so I'm going to give you an example of a natural adoption of a more roundabout means of production. It comes from basically my childhood. But when I was a young boy in my hometown, there were several firms that were dairies. They had cows, they would milk cows, and they would sell the milk. And it was a very direct means of production. There was like 6 guys, each had their own dairies, they each had their own cows, they each had their own milking machines, and they drove the milk into town and had it distributed to people. As a matter of fact, it was so direct that a guy would come to my house every morning and put the milk outside the back door. It's amazing. That's about as direct as you can possibly get. Now, what happened by the time I went away from college is that whole industry became more roundabout on a regional and national scale. And all of those independent dairy producers who had their own cows, who milked their own cows, who bottled their own milk, who brought it to town and then had it distributed, they were all gone. And what ended up in its place was a company that had cows here, cows there, cows here, cows over there, spread all over the state. Those cows would be milked. The milk would be transported to a production processing plant. The processed milk would then be shipped to warehouses. Those warehouses would then have trucks that would go to various grocery stores and other places and distribute the milk. And then ultimately you had to go pick the milk up yourself. So one firm would replace dozens of smaller independent firms. And so you can see that whole process is much more roundabout, but it turns out that it's actually much more productive and that the milk products can be produced at a lower cost. But notice what happens when you do that. The independent guy didn't have marketing, counting systems, all that kind of stuff. But if you get a large integrated firm, they're going to need managers, CEOs, marketing, all that kind of stuff. In other words, the small independent dairy operation was a business that was operated mostly out of the home or the barn, whereas this integrated company was not. It would need a central office location. So as companies become larger, as they adopt more roundabout and complicated production processes, guess what? They need a headquarters. And so the need for a headquarters is going to increase the demand for office space in large central business districts. Hence the need for more and more office space, and hence the desire to produce extra large skyscrapers. The third and final Cantillon effect is the impact of higher record-setting skyscrapers on the construction industry itself. Whenever there's a new record-setting skyscraper, there's a story to be told behind the scenes about all the technological developments that took place in order to make that building possible. As you build higher and higher, every system in a building has to be developed basically brand new. So things like air conditioning, plumbing, sewage, electric, elevators, security, technology, the ability of the building to withstand wind and rain, earthquakes. All of those problems become larger and larger and larger as you build higher and higher and higher. And if you think about it, it makes perfect sense. If you build a building that's 100 stories high, it means you've got to get water 100 stories up, and it's got to be enough water to support all the people working on all 100 stories. But you don't want to just make the pipes larger, make the ductwork larger, just make the elevators whatever. Because every time you use a square foot of space for air conditioning or elevators or whatever it happens to be, that means it's one extra foot on every single floor that you can't rent out. Okay, so if you just used old technology to build a 200-story building, the entire building itself would consist of all the pipes and drains and wires and elevators, and there would be no space on the floors themselves for people to live or to work or whatever they're going to happen to use that building for. So new technologies have to be developed, particularly in the case of elevators. They have to come up with a new way of doing things, essentially. The latest one, they had, I think, 6 sets of elevators, and each elevator actually was 3 elevators stacked on top of one another. So that when it opened on 3 different floors at the same time, and then closed. And they had to come up with a new, very sophisticated computer program in order to run those elevators through the building to minimize people's time spent in trying to get up or down on that elevator. So I think it was that you went to a particular floor, either floor 1, 2, or 3, to get on the elevator to go to your designated where you wanted to go. So all of those things relate skyscrapers via Cantillon effects to the Austrian theory of the business cycle. So it gives us confidence, at least some confidence, that this predictor, this indicator, is actually going to be successful in predicting business cycles. Okay, and then the housing crisis. These things are kind of intermingled with one another. Now, how did we see the housing crisis coming? Well, there's an art as well as science to this. There's nothing perfectly straightforward about analyzing the macroeconomy and coming to a definitive conclusion as to where we happen to be in any particular business cycle. So there's a lot of theory that we use. There's a lot of statistics that can be applied, good or bad, but there's always a little art to it. Now, in the case of the housing crisis, I've got the federal funds rate, which is the rate that the Federal Reserve actually controls over the last several decades. In fact, over half of a century. You can see that the interest rates were at their highest levels during the mini depression of the early 1980s, and that they've subsequently fallen over time as the Fed has caused large increases in the supply of money within the United States. And this final, let's see, the year 2001, there was a recession. The Federal Reserve cut interest rates from over 6% down to 2%, and then eventually down to 1% in the early 2000s. I would like to note, just for your edification, that in 2001 and 2002, economist Paul Krugman, writing in the New York Times and elsewhere, was calling on Chairman Greenspan of the Federal Reserve to cause a housing bubble. So if you go back and look at his columns, you'll actually see him calling for a housing bubble. And I put that on the Mises blog several months ago. Several enterprising Mises.org readers cut and pasted some of those quotes and then pasted them into Krugman's blog on the New York Times. So he had a little tough time explaining all that. So basically, this is where the housing bubble is. You can see that interest rates here are much lower than they had been over the last several decades, and were kept down there for a very long and extended period of time. Not surprisingly, the banks are borrowing at the federal funds market, lending that money for a variety of different things. And in this case, we're looking at the 30-year conventional mortgage rate. Again, very high in the early 1980s, and then gradually declining. And then with a recession right here, and the federal funds rate lower, mortgage rates were about 5.5%. Now, subsequently with a bust, they've even gone even lower than that. You could actually get a 30-year mortgage if you qualify for under 5%. Now, interestingly enough, and in line with the Austrian theory, you can look at the personal savings rate here in the United States. Traditionally, through time, the savings rate of Americans has been around 10%, 8 to 10% on average over a long period of time. But as interest rates have been brought down over time, one of the things that happened in the United States is that the savings rate has declined. It actually turned negative briefly right before the crisis began in the United States. I've put some lines here to track sort of the general trend of the personal savings rate because it's a very volatile statistic. But we see here, leading into the crisis, savings rates in the United States of about 1%. That's incredibly low compared to the past in the United States and other countries around the world. The developing countries like China are saving 20, 30, 40, 50% of their income in terms of savings. Now, with the beginning of the crisis, the savings rate has actually popped up and is almost back to normal levels. People have stopped borrowing, they've lost access to credit, and they're fearful that they're going to lose their job, so they're paying down credit cards and they're saving money, they're setting emergency money aside. One of the things that's very important to remember, it hasn't been brought out to a large extent, but when the central bank brings about a boom in the economy, one of the things that happens is that more money goes into investment, into these more roundabout male investments, but also consumption increases. Okay, so savings is going down and consumption is increasing. So the boom phase of the economy is characterized by more investments, more profits, more capital gains on the investment side, but also more consumption. So it's not surprising that everybody's happy. You're getting to consume more and you're getting higher asset prices. Everything seems to be too good to be true. And the follow-up on that is that's because it is too good to be true. Cannot last forever. This is real private residential fixed investment in the United States from 1970 to the present. And again, I've drawn a line on here to give you some idea about the general trend of what's happening, where I'm touching the line to the peaks of that statistic over a period of several decades. And then right about here is when that tax law changed, which allows you to shelter capital gains on your house to increase that amount of sheltered capital gains. And so housing takes off right here for basically tax reasons, and this little bump up. And then it sort of returns to normal. And of course, this is the tech stock bubble too. But notice this right here, that in the recession, the gray lines are official recessions. This is basically the only recession where investment in housing has continued to increase. In other words, in most other recessions, you see declines in new residential construction or investment. This is the only one that got through it, not only in terms of it being totally positive throughout, but actually in better shape than during the preceding boom phase in the economy. So that's a pretty clear indicator here that something is amiss. Something is different this time with respect to housing. And then, of course, after that, this is the housing bubble itself, where there's a big run-up in the amount of residential fixed investment. And then, of course, it starts to decline here and has fallen below historical trends. Probably an even better visual indicator here is housing starts in the economy. Over a long period of time, the average housing starts in the U.S. economy is about 1.1 million units, and that statistic is very erratic due to the business cycle itself, due to changes in interest rate in particular. But beginning in the 1990s, it was upward, and then by the time we get into the housing bubble itself, we're already at record levels of new housing starts, and then we set a new record. What is that? 1.8 million houses, and now we've fallen down to 4 to 500 units, and there was a report just out recently that the last month that the new housing starts on an annualized basis were less than 400,000 units. And actually, I predicted that new housing starts, to some of my colleagues, that new housing starts would fall to all-time record lows before the end of this crisis would occur, and it would seem that we're already at that level. And then finally, on the labor side, This statistic is the number of construction workers who currently employed, and I've drawn some trend lines around that series. Obviously, the U.S. population, the economy is getting bigger over time, so the number of people in construction, you'd expect that to increase over time, and the variation within there is the result of the business cycle. We only exit that trend at the beginning of this housing bubble. Obviously, we're very far beyond the trend right before the recession and the crisis begins, and now we've fallen below the other trend line. And we can probably expect that number to get worse over time. So that's the facts as they are sort of laid out with respect to this housing crisis. And what I want to take a look at now is what our leaders in Washington, D.C. at the Federal Reserve were saying to us during the peak of the housing bubble itself. Two Federal Reserve Bank of New York economists, McCartney and Peach, were set to study this question of the housing bubble in 2003. And in 2004, they published a report that ultimately concluded that fears of a housing bubble were unfounded. Quote, "Our main conclusion is that the most widely cited evidence of a bubble is not persuasive because it fails to account for developments in the housing market over the past decade. In particular, significant declines in nominal mortgage interest rates and demographic forces have supported housing demand, home construction, and home values during this period." So, it's not a problem, it's just things have changed. Chairman Alan Greenspan dismissed the very idea of a housing bubble. Quote, "The ongoing strength in the housing market has raised concerns about the possible emergence of a bubble in home prices. However, the analogy often made to the building and bursting of a stock price bubble is imperfect. Even if a bubble were to develop in a local market, it would not necessarily have implications for the nation as a whole." No implications for the nation as a whole. The current chairman, Ben Bernanke, who in 2006 was the vice chairman, I guess that's the chairman in charge of vice, but he believed in 2006 that the mortgage market is more stable than in the past. Now, this is at the time when interest-only mortgages, no documentation mortgages, liar loans, all sorts of crazy, unconventional mortgage products were in their heyday. Bernanke noted in particular that, quote, "Our examiners tell us that lending standards are generally sound and are not comparable to the standards that contributed to broad problems in the banking industry 2 decades ago. In particular, real estate appraisal practices have improved." Sounds good. And I think that we should all contrast that with, for example, the work of Frank Shostak, who in 2003 showed that we in the United States were actually having a housing bubble. Or Christopher Meyer, who in 2003 on Mises.org showed that we were having a housing bubble. That was before any of my publications. I'd also like to bring up a fellow economist, Tyler Cowen, who on his Marginal Revolution blog made the following post during the height of the housing bubble. It's titled, If I Believed in Austrian Business Cycle Theory. That's the title of this blog post. If I Believed in the Austrian Theory of the Business Cycle. He used to believe it when he was a kid, but now he's grown up. He's got his own theory. 1, I would think that the U.S. economy is overinvested in non-export durables, most of all residential housing. 2, I would think we've piled on far too much debt in both private and public sectors. 3, I would think that these trends cannot possibly continue. 4, I would think that the U.S. economy is due for a plunge and a massive sectoral shift towards exports. Furthermore, I would think it would not handle such an unexpected shock very well. 6, I would buy puts on T-bond futures and become rich, which actually would have been a great idea. And 7, I would think that F.A. Hayek's book, Monetary Nationalism and International Stability, now priced at $70 a copy, is a secret tract of our times. And then he ends the blog post by saying, of course, that is not me. So that's what they were saying versus what we were saying. We were saying there was a housing bubble, well, actually, before they even started saying anything at all. I guess, I don't know who they were responding to because, well, we were practically the only people saying anything about the housing bubble itself. Now, finally, I want to look at the cause of the housing crisis because there's so much talk about so many different things. Fannie Mae, Freddie Mac, the Community Reinvestment Act, mortgage-backed securities, credit default swaps, improper accounting standards, rating agencies gone awry, too much regulation, not enough regulation, speculation, and greed. And what we say is the cause, which was the Federal Reserve, easy credit policy for an extended period of time. What do we make of all that? Well, first of all, the central bank and the Federal Reserve is a necessary component of any boom, of any bubble. You can't have a boom or a bubble without the Federal Reserve intervening in a particular way in this market. And when they lower the interest rate and increase the amount of credit in the economy, there's going to be a boom. What all of these other factors do is steer that credit in a particular direction. They're steering mechanisms. And all of those mechanisms, in part or in whole, helped steer all this extra credit in the direction of housing. So those are contributing factors and defining factors. All those other factors are the housing part of the housing bubble. But the bubble itself is caused by the Federal Reserve. Okay, so it's not that, so Fannie Mae couldn't cause a business cycle on its own. Mortgage-backed securities couldn't cause a business cycle on its own. Only the Fed can do that. Okay, we've got a couple minutes for questions. Yes, ma'am.
What was the government culpability behind
Well, they were, in the tech stock bubble, it was basically just the Federal Reserve itself, just easy monetary policies, both directly and indirectly. Okay, they reduced the interest rate, they created easy credit conditions, which fed into the stock market, but Greenspan also, through a policy of regular bailouts of Mexico, Russia, currencies, the Asian contagion, all of those bailouts basically reduced the assumed risk of people investing in the stock market because anytime there was a big problem, Greenspan would help bail it out. So easy credit plus less observed risk was the principal causes of the tech stock bubble. Yes?
Can I just come back to it? I actually lived through the bubble. I was an equity analyst at the time, and it was quite clear that the applied growth rates in tech stocks was impossible. So there was a reverse DCF.
Right.
They couldn't grow up the rate that was applied. But it struck me that most of the investment in technology is equity. And it wasn't debt, it wasn't credit. Though I accepted the point about the interest rate, it certainly wasn't a flow of money from credit going into the market. So I'm just wondering how that squares up with the markets. I understand what's got the green stamp, but look, banks are certainly not lending money to technology companies.
Well, they were lending money elsewhere in the economy. It doesn't necessarily have to go directly from banks into tech stocks. It can go from banks to other people into tech stocks. So the channels of these things are very difficult to unwind. And each cycle, each boom and bust is going to have an entirely different set of influences and factors and associated with it. So that's what you have to put together in terms of the history of it, is, following the lines of where the money comes and where the money goes.
We have a research project to actually track that in detail.
Yeah. Yes, sir.
I know I should know this, but I was wondering if you just look at the easy definition of the Fed funds rate and how that actually gets. When the Fed funds target rate is lower, how does that actually get out? Is it given to commercial banks?
Yes. Yeah, the federal funds rate is the large New York City banks, essentially, the interest that they charge each other on short-term overnight loans. Okay, so what happens is that the Fed wants it at a certain rate so business can form expectations, and so the banks can borrow and lend at that rate. If no one's willing to lend at that rate, then the Fed will enter the market and influence the market to maintain that rate.
They do that by buying government debt and then increase the money supply?
Yes, they buy government debt from the banks so that the banks end up with more reserves on their balance sheet, and those reserves can then be lent out as new loans the next day.
I was just wondering, in your skyscraper analysis, did you include the Rockefeller Center in the depression?
No, I didn't. Well, I'm not discounting the factor that just the building of large structures, like Doug French was mentioning, the large structures that were built in Las Vegas. All of those have an influence too. It's just that the high skyscrapers are related directly to the Cantillon effects. But there's a lot of large structures that have ended up being related to crisis in the economy. And also, I want to point out the Woolworth building. I was hoping somebody was going to ask me a question about that, but the Woolworth building set a record in 1913 without any crisis associated with it. What happened is that the United States was entering a crisis. The economy was collapsing right before the Woolworth building was, right after the Woolworth building was opened. But then World War I broke out, and the demand for U.S. production in Europe shot up, to record levels. And so that the intervention of World War I prevented the Woolworth building from being related to the Panic of 1913, or whatever historians would have called it, had it been allowed to play out. Yes, sir.
Would you recommend investing based on the traditions that skyscraper model makes?
I did. It's weird. When you're making money and everybody's losing money, you don't like to talk about it. But investment is hard, and investment can influence your thinking about certain things. So it's sort of, it follows your own personal thinking. If you're invested in something, then you get too attached to it. And as a result, one of the worst things, I was out at Las Vegas speaking on the price of gold. And somebody asked me, is there any way to lose money in gold these days? I said, of course there is. I said, you think you know what's going to happen to the price of gold, and the one sure way of losing money is to think you know what's going to happen. It's the most dangerous condition an investor can face. So humility is the word of the day with respect to investing. Thank you very much.